All right. Welcome, everybody, to the first Business Brilliance podcast ever. This is a really, really good one to start off this new series for you guys. Essentially, what we're trying to do is provide you guys with expert insights from experts around the world at the world's top companies, right? The world's top companies, the world's top minds. That's what we're all about, right? And if you guys don't know what Business Brilliance is quite yet, just a quick summary about it. We are the world's first centralized community of ambitious students from top schools around the world. And essentially, what makes us stand out and what makes us so unique is the fact that we're uniting all of these different students across all of these different borders, currently in 19 different countries, and we're uniting students across various majors, backgrounds, and interests. So today, I am joined here with Jay Bryson, the chief economist of Wells Fargo and the managing director or one of the managing directors of Wells Fargo. So, Mr. Bryson, if you would like to introduce yourself, that would be lovely.
Okay, yeah, great. Thanks, Shane. So, as you noted, I'm the chief economist of Wells Fargo. I'm based in Charlotte, North Carolina. We have a team of total of 17 people on the economic staff here, and I've been here with Wells Fargo and predecessor banks for it's 26 years now. So, long career here, but I've had been other stops along the way, and I'm sure we'll talk about that.
Yeah, amazing. And so you've had a quite an extensive career, not just within the realm of economics, but you've had an extensive career at Wells Fargo as well. You served as the global economist for quite some time, and as we'll get into more of your experience, I think what we should definitely start off with is, how did you even get here in the first place? Where did you sort of come from? What is your educational background, and what personal characteristics drove you to be able to get in such a successful position at this point in your life?
Right. Well, okay. So let's go back. So I went to did my undergraduate work at University of North Carolina at Chapel Hill. Graduated there in 1980, and when I graduated, I figured that would be the last time I would be in a college classroom, at least as a student. Right. I had a job with Armstrong World Industries. They made floors and ceilings and things of that nature. I was a marketing representative for them in Minneapolis, and I just figured that my business career was going to take off, and I would climb up the corporate ladder. After about a year or so, it became utterly apparent to me that I was miserable and that I needed to try to do something else. So I pulled a 180. All right, so what do I like? Well, I've always liked economics. So I'll go back to graduate school and get a graduate degree in that, and that's what I ended up doing. Looked at a few different schools, but ended up going back to UNC Chapel Hill. Got my PhD in economics in 1989, and then moved from there to the University of Alabama. And I was an assistant professor of economics there, and an opportunity arose about 3 years later to move to the Federal Reserve Board in Washington, D.C., where I would be in their international division. And being someone who's always been interested in economic policy, to work at the Fed is, kind of like a dream come true, right? And so I went to the Fed, had a great time, working at the Fed, learned a lot, really exciting place to learn, to work at. But after about 5 years or so, I mean, it became apparent to me that I was never going to be, the right-hand person to the chairman of the Federal Reserve, and that's fine, right? You don't necessarily need to do that, but an opportunity did come up to move to the private sector, to become an economist for a predecessor bank to Wells Fargo, and so based here, would it be here in Charlotte, and having spent a good number of years of my life in North Carolina, up at Chapel Hill. The thought of coming back to the Carolinas, where life was a lot less complicated, it was a lot less expensive than in the nation's capital. That looked like a pretty good trade to me, and never looked back. And 26 years later, here I am.
That is so, so amazing. And I think that just how ambitious you must have had to be throughout your entire career to just continue climbing all of these different ranks throughout all of these different corporations and really just all of these different stages throughout your life. I'm curious, based off the fact that you are, the chief economist of Wells Fargo now, What do you love so much about economics that makes you so passionate about your position and to be in this position for so long?
So the thing really like about economics is it kind of combines the real world, right? I mean, we're talking about what's really happening out there in terms of the economy, with a little bit of academia as well, right? I mean, there's a public policy part of towards economics as well. And the interesting thing is when I reflect back on my academic career, what I really enjoyed there was teaching, being in the classroom. And today I still get a lot of satisfaction from just mentoring. And at the end of the day, teaching is a form of mentoring. And so people who know my background will say to me, do you ever miss teaching? And my answer to that is, I mean, you kidding me? I teach every day, right? I teach, or I talk about economics to non-economists. And so what I'm doing here as the chief economist for Wells Fargo, it's very, very real world oriented. We're talking to clients all the time about what we think is going to happen to the economy, what's the Fed going to do, et cetera, et cetera. But I need to be doing it in a manner in which those people, those clients, can understand what I'm talking about. And so again, what it does is it's combining kind of the real world sorts of things with a little bit of academic, sort of mix in there as well.
Yeah, that's amazing. And I just asked you the question, what do you love so much about economics? But I'm curious to hear what you think about why other people should care about economics as well and why it is so important.
Well, so from a business background, why do you care? And it's interesting now. So I have classrooms now, right? I get up, I do a lot of public speaking. We'll call that my classroom now. And when I look out to my classroom now, my students, if you want to call them that, the business people who are sitting out there, they're very engaged, very much listening to it, more so than maybe some of my students were back when I was actually in an actual sort of classroom. And so why should they care? I mean, at the end of the day, their businesses are going to be driven in part by what's happening in the macro economy. Now, maybe you've come up with the latest and greatest mousetrap or something like that, and it's going to revolutionize the world, and it doesn't really be affected by the overall macro economy. I mean, clearly there's some businesses that are like that, right? But for most businesses out there today, there's some cyclicality to them. They're very much driven by what's happening in the macro economy, what's happening with interest rates. And so, I think that, business people need to be able to understand some macroeconomic concepts to help them with, making business decisions.
Yeah, I completely agree. And I think that, in my point of view, I definitely think that economics is something that really, like you said, it's the real world. Like it's real life and it affects pretty much everybody, right? Like the interest rates, although you can develop relationships with private bankers and things of that sort to get, adjusted rates, generally they are all the same. And I think, one thing before we start to get really technical into the conversation of, the current state of the economy is before we get into it is as a chief economist, with somebody who has so much knowledge about economics, how would you, in layman's terms, define, interest rates and, the consumer price index and just those main terms so that everybody can understand sort of what is driving our economy right now?
Yeah, so I mean, so you started with interest rates. Well, I mean, essentially, it's the cost of borrowing money. And anybody who has a credit card right now, certainly knows that if they're not paying that credit card off every month, they're going to see a charge on top of that, an interest charge based on that. Most of your people listening to this podcast probably aren't in a position right yet where they're actually buying a home, but and sooner or later that's going to happen. And so again, it's the cost of money to borrow to buy that home. In terms of the consumer price index, it's just a measure of all the prices in the economy. You can look at your iPhone and you can say, so is the cost of this going up or is it going down over time? Is what's the cost of bananas doing over time? Et cetera, et cetera. There's thousands, if not millions, of different types of goods and services out there. And what the Consumer Price Index does is it tries to aggregate all that information into essentially one number. What's the general price level out there? Are prices in general going up? And if so, at what rate are they going up? Or sometimes the general price level actually goes down. That's kind of rare, but sometimes that happens as well. And so that's how I would define that.
Yeah. And for those who don't know, how does inflation affect the consumer price index?
Well, so inflation is the rate of change of the consumer price index, and so think of so use an example here, and I'm making these numbers up because I have no idea. A dozen eggs, right? A dozen eggs might be $3.99 a dozen. All right, so that's what's called the level of those prices, $3.99 a dozen. What's the cost of that a year ago? Well, if it's was $2.99 a dozen, then and then that rate of change is, what is that, about 33%, right? And so that would be the inflation rate of at least it's the rate of change in terms of eggs here.
Awesome. Yeah, I think somebody listening definitely learned something just from that little section
Mhm.
alone. And, just to take this conversation into a broader point of view, you served as the global economist of Wells Fargo for, nearly 2 decades. How do these more domestic terms that are really just affecting individual economies play into the bigger picture of the global economy? And what sort of trends and challenges have you seen the global economy face over your time?
Well, so generally the same sort of economic concepts that we talk about here in the United States certainly apply to if you're looking at the Canadas and the United Kingdoms and Germany's, et cetera, of the world, right? They have GDP measures, they have inflation sorts of measures, things of that nature. In terms of the data that you need to analyze those economies, the United States is kind of the gold standard when it comes to data, economic data. The data in some of these other countries just isn't quite as deep or as broad as is here, and so that provides some sorts of challenges because to analyze an economy, you want as much data as you can get your hands on. Now, when I was talking about the Canadas and the United Kingdoms, the Germanys, Japans, et cetera, when you start to move to some of the developing countries of the world, particularly really small developing countries that are very, very poor, it's really difficult to get good data out of those countries. They just don't have the economic means to be able to produce that sort of data. So if you're talking about pick a country, Namibia, for instance, right? If you wanted to look at the economy of Namibia, that may be very challenging, just because there's just not a lot of really good data behind that. So that's some of the challenges that you face when you look at particularly developing economies around the world.
Yeah. And so for global economics, I think nowadays we're starting to see a lot of new different things come into play within the economy, such as, crypto, we have foreign exchange rates changing, and we also have war and politics affecting all of these, which we won't need to get into. But what I'm thinking is, how do you sort of see the future of the strength of the US dollar in comparison to all of these global currencies? And more importantly, how do you see the strength of the US dollar in the future in comparison to crypto as well?
Okay, right. So, in terms of the value of the dollar, so let's start short term, and then we'll kind of talk, move a little bit into longer term. Right now, if you look at the dollar versus many currencies, if not most, is pretty strong right now. Anybody who traveled to Europe in the last year or so would certainly, recognize that it's relatively cheaper to go to Europe just because the dollar's kind of so strong. Now, in the next year or so, we think the dollar probably won't be quite as strong. And the reason why is we think the Federal Reserve will be cutting interest rates. And I'm not going to get into all the theory here, but lower interest rates tend to weigh on the value of currencies. And if the Fed is cutting rates, then the value of the dollar should kind of come down. So those are kind of cyclical sorts of things. Some years the dollar's kind of strong, some years maybe it's a little bit weak. But is the value of the dollar going to crash? Is it going to is it going to completely fall out of bed versus many of those other currencies? And my answer to that is probably not. Not in the foreseeable future. By that I mean the next few decades or so. The reason why is at the end of the day, so first of all, the U.S. economy is kind of still the global benchmark. It's still the largest economy out there in the world. And in terms of investable assets, there's no place like the United States. We have the deepest, most liquid, most most broad capital markets in the world, right? People can buy corporate bonds, they can buy U.S. Treasuries, they can buy stocks, they can buy real estate, et cetera, and it's all very, very transparent. And because of that, people want, when they buy a U.S. stock, or if they buy a U.S. business or an office building or whatever, they know what they're getting. And so we attract a lot of capital inflows into the United States from foreigners who want to invest here. And as long as we don't kill that golden goose, and I don't see that anytime soon, that's going to continue to attract capital inflows here, and that will keep the value of the dollar relatively strong. On the other hand, you look at some other countries. So I'll pick on China, for example, right? China's the world's second largest economy. So what did I say about the United States? Deepest, most liquid, most transparent capital markets in the world. If I'm free associating, if you say, okay, I'm going to say the word China, and I want you to say the first 10 things that's going to come into your mind. One of those words for me, and arguably for many other people, is not transparent. Right. And so, people, if they invest in China, they don't really, because it's not really all that transparent. You may not exactly know what you're getting there. Plus, the rules of the game can change pretty quickly in China. And so because of that, is the Chinese yuan going to supplant the US dollar as the world's reserve currency anytime soon? Seriously doubt it. All right, so what about things like, digital assets, cryptocurrencies, things of that nature? So first of all, if you say to me, tell me where you think Bitcoin's going to be versus the dollar a year from now, I have no idea. I mean, I just don't, I just don't forecast Bitcoin or things of that nature. However, it gets back to that capital asset sort of thing. Buying Bitcoin and and Tether and Ether, et cetera, some of those digital sorts of currencies, that's fine. It can be part of people's portfolios, et cetera. But for them to really become part and parcel of currencies, as we think about the US dollar, the euro, things of that nature, you need to have assets that are, investable sort of assets. That is, stocks and bonds that are denominated in cryptocurrencies. So let's start on the issuing side of things. If you're a corporate treasurer, do you want to issue securities that are denominated in Bitcoin? Probably not, given the volatility of that price, right? You're a corporate treasurer. You want to be pretty sure what your, and particularly if your assets are valued in dollar terms and your liabilities are valued in crypto terms, you can get a real wicked asset liability mismatch, which you don't want. So when you look around the world, there's not that I'm aware of any stocks and bonds that are denominated in Bitcoin right now. And if you're an institutional investor, you're a pension fund, right? So you've got to pay out billions of dollars a year in terms of liabilities, in terms of pension liabilities. You need to know what those things are going to be. You need to know what your assets are going to be able to pay off those liabilities. Do you want to be investing in Bitcoin, which can have huge price swings on a day-by-day basis, let alone a month-by-month, year-by-year? Probably not. And so the point here is, yes, those digital assets for the foreseeable future may be small parts of people's portfolios, but I don't see a world in which they completely supplant national currencies like the US dollar or the euro or things like that anytime soon.
Yeah, and that's definitely an interesting analysis because, like, once again, in my point of view, I think that crypto is very, very unique in the sense that, it's affecting the economy by saying that instead of having, say, $50,000 in the bank that is pretty much owned by the economy at that point, you have this $50,000 sitting in a digital asset that is one, completely decentralized on the blockchain, and then two, not really regulated by the government, so let's say publicly per se. And another interesting thing that I think about crypto that I would love to hear your thoughts on is really just sort of how Bitcoin started, primarily in comparison to how, say, the S&P started way back in the day, and how sort of they're starting to show like a little of the same exact patterns where there is like a lot of risk and fear, that people have at the forefront of their minds initially when investing in it at the beginning of, this whole thing's creation. But, with Bitcoin being just a little over a decade and 10 years old, let's say, what happens to the US dollar when people start to get more confident in their money increasing via crypto and Bitcoin than they do with just having it sit in the bank with a 3% yield every single year? And, when people start to see that Bitcoin and crypto is starting to produce more returns and is a better investment over time than the majority of stocks, which are, could be perceived as more volatile, how do you see that whole thing playing out for, where money is within the economy?
So I'm going to push back on your notion about the volatility. Yes, stocks and bonds are volatile, and you talked about, yes, you have it sitting in the bank earning 3%, but you know what? For most people, that 3% is guaranteed. It's guaranteed in the sense of if the bank fails, the U.S. government through the FDIC is there to bail them out, right? If when you talk about crypto, you also, another thing you said, it's not regulated by the federal government. We know there's been hacks in terms of that. If you lose your $250,000 in Bitcoin, no one's coming to the rescue there, right? So I can see a world in which I'm going to call it digital assets play a more important role than what they do now. And so Tether is a good example of this. Okay, Tether, is it's called a stable coin because it doesn't change in value versus the US dollar. In theory, it's supposed to be backed by government bonds and things of that nature. There's some questions about that. And whether it actually is or not. And we've seen runs on Tether before when people have thought, it may not be completely sort of backed by that. The great thing about stable coins and digital assets in general is their ability you can make instantaneous payments in that, right? And so if I buy a machine from you for $1 million, and I take possession of that machine, I can transfer $1 million in Tether to you instantaneously to pay for that, rather than having to go through the bank process where your money's tied up for a few days, et cetera, et cetera. So those things are great, but what you need to do in terms of the digital sort of assets, it needs to be back. The reason banks work today is because they are backed by a robust supervisory and regulatory framework. People trust banks, okay? And if you go back any reading of economic history, before 1913, before the Federal Reserve was founded, there were runs on banks, tremendous runs on banks. Banks failed, and as more and more banks fail, you end up going into depressions. And so that's why the Federal Reserve was created, and all the other regulatory things that are around that. And so the point here is there a world of in the payments atmosphere for crypto or digital assets, I should call them more broadly, in general? Yes, there is. And what we don't want to do is we don't want to kill that. The great thing about that sort of finance, decentralized finance, is the innovations that come from that. That's what you want. You want the innovations that's coming from that sort of world in terms of payments technologies. but it also needs to be backed by a robust regulatory and supervisory framework so people can trust it, that you don't have the runs on the tethers that we have seen in the past, because that can then lead to economic and financial calamities when that happens.
Yeah. And, I definitely think all that is very, very interesting. And one of the last points that I want to make on the whole digital assets conversation is, what are your thoughts on, the world's largest asset manager, BlackRock, now owning the largest share of Bitcoin and having just bought $20 billion worth of Bitcoin? And yeah, I'll leave the question at that for now. Interested in hearing your thoughts on that.
I don't know what, so he's $20 billion. I don't know what BlackRock's assets under management are. I'm going to guess it ends with a T,
Yeah.
as in trillions of dollars. So $20 billion sounds like a big number, but it's a very small part of what BlackRock has in assets under management. And that brings me back to my other point. Will cryptocurrencies be part of people's portfolios? Yeah, sure. But is it going to be their predominant sort of things? For most people, I think that would be ludicrous to put all that money into cryptocurrencies. It's great when it goes up, but when you think about the crypto winter of whatever year that was, 2 years ago, when Bitcoin goes from $70,000 down to $20,000, you don't want to be on that side of the trade, right? So I think it's going to, is it going to be parts of people's portfolios? Sure. But I think it's going to be the BlackRock example. I think is very pertinent here. $20 billion of, trillions of dollars of assets under management. It's a pretty small part.
Yeah, interesting. Very, very interesting. And I honestly tend to agree with that. And, another thing in regards to BlackRock and, how I feel like they're sort of affecting the economy that I would love to get your thoughts on is, BlackRock has notoriously been buying up a lot of single family homes. It's BlackRock and Blackstone, right? They've been buying up countless single family homes from Americans all across the nation. And I'm interested in hearing, what do you think of how that is able to affect the economy? And then, on top of that, do you think it is just dangerous and risky for home buyers to just be exposed to this sort of behavior by such a large asset manager?
Well, so if you look at what's happened to home prices over the last few years, home prices have gone up around, tremendously around the country. I don't think it's so much so we talk about Blackstone, you talk about BlackRock, things like that. Are they causing those prices to go up? I don't think I don't think that's a big reason why prices have gone up. Prices went up a lot when interest right after the pandemic, when mortgage rates went down to 3%. And so you just had a huge increase in demand back then. And if the demand may have, part of it came from BlackRock, part of it comes from Blackstone. But if those folks weren't doing it, normal people, normal home buyers would have been stepping in there as well. House prices today remain elevated, not so much because of demand, it's because of supply. We just aren't building enough homes in this country. It's difficult to build homes because of a bunch of different regulations, environmental laws, et cetera, et cetera, et cetera. The other thing that's also happening here as well is you just don't have the turnover in the housing market like you used to. And the reason why is when you look at mortgage rates, over 90% of homeowners have a mortgage rate today that's 5% or below. Okay, right now, a new 30-year fixed rate mortgage is close to 7%. And so when rates are a lot lower, then people, they want to trade up. They move out of their house. They move out of their starter home. And then that opens up a starter home for somebody who's not in a single family house right now. If you got a mortgage rate, a 30-year fixed rate mortgage rate, let's call it 4.5%. And if you want to move to a new home, you're looking at 7%. Unless you have to move, you probably don't want to do that. And so that's part of the problem, right? There's a supply issue right now. And, Shane, I think that's going to affect your generation for years and years to come. I don't think the value of homes on a, let's call it a nationwide basis, is going to come down significantly anytime soon, until we start to fix that supply sort of thing. Now, in certain certain locations, they might. I mean, at the end of the day, all real estate is local, right? But if you're looking at on a nationwide sort of basis, or house prices on a nationwide basis going to come down significantly, the answer to that is I just don't think so. I just don't see the mechanism that would happen unless we just start building tons of new homes.
Yeah. And we see the importance of the housing market and, an unfortunate example in 2008 whenever, the entire market crashed based off of mortgages and things of that sort. But, I'm curious, based off how you're sort of talking about, the future of, I guess, the housing market in specific, what do you think? Do you feel like there's a trend developing towards a recession right now? Or what are your current thoughts on really just America going into a recession anytime soon?
So you have to go back and say, how did recessions happen? They happen one of two ways. The first way is what's called an exogenous shock. It's a technical term, right? Exo meaning external. And so these are things that generally just come kind of out of nowhere. You don't see coming. Okay. So give you some examples. Pandemic, right? In 2020. Nobody saw that coming a year before that. If you go back to an example from when I was your age, back with the oil shocks of the 1970s, those things, people don't see those things coming. Geopolitical conflicts, same sort of thing, right? If China were to invade Taiwan tomorrow, that's probably a pretty big economic shock around the country. Those things, by their nature, are just impossible to forecast. We know that they're out there. We know that they can happen at any time, but I can't forecast them. And so the way a forecaster handles that is you assume they don't happen until they do. And then when they do, you change your forecast. The other way is when something in the economy that's large enough gets way out of balance, and then when it corrects, the correction is painful enough to pull the entire economy down with it. Okay, two recent examples. One would be the tech bubble of the late 1990s. When that bubble blew up and corrected, that was a big enough correction to bring the entire economy into a modest recession. And then what you had mentioned earlier was the housing bubble of the 2006 to 2008. That the financial crisis associated with that. That was a huge hit just because of the amount of mortgages that banks held, and that caused a lot of problems in the banking sector. So with that backdrop, looking out there, what's out there that is way out of balance right now? Frankly, when I look around the economy, there's not a lot of huge things that are way out of balance right now. The underlying fundamentals of the U.S. economy are generally pretty good. And so, if you say to me, knowing what you know right now, what would you say the probability of a recession is in, say, the next 12 months? I would give you 30%. Okay. And just to handicap, or just to put that into context, if you go back to the end of the Second World War through today, the US economy has been in recession roughly 15% of the time. So it's not our base case, but it's a little bit elevated. And we are seeing some signs of stress in the household sector. I wouldn't say it's real widespread. This is not 2006 with a housing bubble. Seeing some signs there. And interest rates are still relatively high. And so that could potentially pull the economy into recession. We don't think that's going to happen, but I'm certainly not clairvoyant. That potentially could. So that would be one of the things. But outside of that, if I look at, say, the banking sector is the best capitalized today it's been in my working lifetime, which is a few decades. I don't worry about that. The other thing that's way out of balance is, or not away, but the thing that's out of balance is the debt of the federal government. But I don't see a Lehman moment there anytime soon. Treasury securities are the gold standard of the global financial system. There's no alternative to U.S. Treasury securities. It's not euros. It's not Japanese yen. It's not China. And so I don't see investors dumping U.S. Treasury securities soon. So, again, could a recession happen? Yeah. And probably the biggest way it would happen would be one of these exogenous shocks that we just can't see right now.
Yeah.
Whether it's a geopolitical conflict or another pandemic or, you name it.
Yeah. And that definitely is very, very reassuring to hear. And, for the people studying astrophysics and the people studying English and the people studying Nordic literature, what would you tell them in order to reassure them that there is not going to be a recession in layman's terms?
Well, so first of all, I can't reassure them that.
Yeah, true.
I wish I could, right? Again, I think the biggest way that you get into a problem in the next 12 months would be something, a geopolitical shock, or again, something that we just can't foresee right now. And those things can happen in any, there's always a underlying probability there's going to be a recession. I guess what I would say to them is again, when I look around the US economy in general today, I just don't see a lot of sign of things that I can see. I just don't see lots of signs of trouble, right? This is not 2006 or 7 when anybody who just looked at what had happened to house prices and you just knew how leveraged the banking system was, you could have guessed there was going to be some issues at some point. We just don't have the same sort of problems today as we did back then.
Right, right. And that is pretty reassuring to hear, to say the least, I will say. And just as we start to wrap this up, I think overall it's been a fantastic technical conversation about the state of the economy and sort of, what to sort of keep an eye out on. But, just to boil it back down to the reason why we're on this podcast, right, is to share these insights so that we can inspire, you as the listener to, learn more so you can achieve the success that you envision for yourself, right? And, Jay, I'm curious, what advice would you give your college self if you could talk to him right now? And how would you just reassure him that, he will be able to succeed as long as he keeps chasing his dreams?
So my first advice I would give to myself, and I think I already knew this, and I'm going to guess many of the people who are listening to this podcast know this already. Just continue to work hard, right? I mean, I still think we are in a system where hard work is rewarded. Whether it's hard work in terms of your studies and getting good grades to get you into that first really good job, whether it's working hard, whether in terms of wherever you land in terms of a business or in terms of whatever career you're going to do, just continue to work hard. And then the second thing I would say to myself, and I think I kind of figured this out as I went along, but this is what I would say to my college self now would be when opportunities are going to arise in the next few decades. And when those opportunities arise, take a really good look at them. Don't just be complacent and stay where you are. Sometimes you do need to jump. Sometimes you need to take, as I did when I went back to graduate school, sometimes you need to take one step back to take two steps forward. And that's particularly true when you are younger. Taking that one step back, when you don't have the responsibilities of a family or, et cetera, that's a lot easier than when you are, say, in your 40s and you're married, you have two children. Taking that step back can be a little bit more painful. So when the opportunities arise, I'll say this as an economist, weigh the cost and the benefits of that. If the marginal benefits outweigh the marginal cost, then by all means, you should probably think really seriously about taking those opportunities as they arise. Your career is probably going to be defined by a number of different jobs, and maybe even different job categories over the course of your career. And don't be afraid to move around to realize things that make you happy, whether it's monetarily, whether it's emotionally, whatever. Take
Yeah.
the opportunities as they arise.
Yeah, I think that's super, super insightful and very, very inspirational. And, one thing that comes to mind for me is that, I think in life sometimes you can give your all and it still isn't enough, right? And I'm curious to hear how much you value resilience. And if you could you speak about resilience in regards to a time that you failed and bounced back and came to where you are today.
Right. Yeah. So I mean, so if you go back to my first job, well, we started this conversation with Armstrong World Industries. All right. So I was resilient for 2 years. I stuck it out for 2 years. Right. I just didn't throw in the towel right away, even though I realized that wasn't really happy doing what I was doing, but thought I'd give it a go. So I was kind of resilient there for a year or two. But then once I decided it was time to call an audible. It was time to do a 180. Um, I was able to do that, and so or made the decision to do that, and I never really ever looked back on that, and so yeah, you folks you're going to be you're going to go into a position in which you may be unhappy for a while. Your boss is a jerk, right? I get it, right? But just at the first sign of trouble, just don't quit. I mean, if I'm looking at a resume and somebody's been out of school for 4 years and they've had 13 jobs in that 4 year period of time, I'm going to say to myself, all right, so what's the what's the issue here, right? So you do have to gut it out, but also when opportunities arise, um, go for it.
Yeah. And one of the last questions that I have is that like whenever you sort of do make big decisions like, leaving a company and going to seek new opportunities and things like that, where do you sort of draw the line between justified resilience and the line between just knowing your own personal worth and keeping, the price of your peace of mind?
Well, I think your peace of mind is very important, right? You can be making $1 jillion a year, but if you're hating it, your life is going to be miserable, right? So I think your own peace of mind is very important there. And I don't have a magic formula for when that point comes. I think people know it. They can feel it. It's okay. It's time to move on. And when you make that decision to move on, don't look back, right? Sometimes it is a leap in the dark, and if you make the leap, don't look back, don't regret the decision that you made. Make the most of new place that you've gone to, and try to make the most of it at that new place. And again, it's not necessarily if you move to point A to point B doesn't necessarily need to be your terminal point. If you get there and after a year or two or three decide that you're not happy there, there's probably a point C, for people. So, but you'll know when that time comes.
Yeah, that relates very, very closely to my favorite quote, which is, in life, you make decisions and you don't look back, right? And I'm
Yep.
curious, what is your favorite quote and one that you try to live by?
Uh, so I think one of my favorite quotes is a quote that um, it's attributable to John Maynard Keynes, one of the most famous economists of the 20th century. Although I think research has showed he didn't actually say it. I'm not exactly sure who did, but whatever. It's attributed to John Maynard Keynes, and that is, I'd rather be vaguely right than precisely wrong. And I think what it means is you got to have a little bit of, you have to be humble. None of us, I used the word clairvoyant before, but the older you get, the more you realize how little you know. And I think you have to go through everything you do with a little bit of humbleness. And so I'd rather be vaguely right than precisely wrong, I think defines the way I try to look at the world.
Yeah, that's beautiful. And one of my favorite quotes that relates to that as well is that, arrogance is your enemy and humility is your hero, right? And walking in the path of light and facing directly towards the sun so that all the shadows can fall behind you is arguably the most important thing to do in life, right? And I just want to thank you so much for your time, Jay. And I think that this was such a lovely conversation. And, in the future, would love to have you back on and sharing your updated insights on the economy and your professional expert insights and as we start to sign off here, I'm interested. Do you have any last words that you would like to share with, ambitious students and people from around the world?
I guess the last words I'll keep reiterating, what I said before in terms of advice. Opportunities are going to rise for you folks. You're in a very good position right now, being the places that you are. You're going to have opportunities out there. Take the opportunities.
Beautiful. Well, Jay, I think this has been an excellent time speaking with you. And I just want to thank you once again for coming out and recording this podcast with me today.
Well, thanks for having me, Shannon. It's been a real pleasure, and good luck to you with the podcast series and everything that you're doing. As you go forward.
Thank you so much. It's been your host, Shane Gardner, the founder of Business Brilliance. Hope everybody has a wonderful day, evening, or night. Take care.